So welcome to another episode of the Makers Podcast. Today I'm joined by Rob Kniaz, the founding partner at Hoxton Ventures. Rob, how's it going?
Great, thank you for having me.
Thank you. So, what is the one thing you wish you did differently before you turned 20?
Differently before I turned 20? Oh, so I came from quite a rural area, so we had a lot of fun. It was an area sort of between Washington, D.C. and Richmond on the U.S. East Coast, so we had a great time before we were 20. I don't think I have really any regrets. I think I was studying computer science at that point at university. I think in our area there weren't as many opportunities to see higher level education programs. So I went to the state college effectively in my state. In my high school, there were very few people that went to Ivy Leagues or top tier schools, so there wasn't really a history and a knowledge of that. I think in hindsight, I probably would have spent more time getting to know the MITs and the Stanfords and the Caltechs. I think it's important for computer science to look at those sorts of schools, but it turned out okay, so everything worked out in the end. But
awesome. And what is your favorite company right now, apart from any portfolio companies in the Hoxton portfolio?
Oh, no portfolio companies. That takes all the fun out of it.
Well, we can do one-on-one. Was one portfolio company and one outside, maybe?
I think right now one of the ones I have the most fun with is Airtable. It's a California company, and it's sort of like HyperCard, if you remember that from way back in the day on the Amiga. Or maybe Google Docs for databases. So it's a very lightweight way of creating databases. You can do it from your mobile phone. You can do it from your computer. It's very shareable, so without really any technical skills, you can create a pretty useful database. You can join data together and make pretty powerful applications that were pretty hard before. Things you would do in spreadsheets, you can now actually do it in a database. I think it's super cool. The growth has been exponential. They just closed a very large, I think, Series B or Series C round in the past few months. I think it's a very interesting kind of company. I think it gives a lot of people the ability to move out of spreadsheets where they currently keep some of their data and do more useful things with it with a proper database. I mean, looking at friends in non-technical industries, so many businesses are run on Excel today. This is an interesting way of letting those folks level up and do a lot more complex things without requiring a complex background of their own.
So for our audience who don't know anything about you, could you just summarize your career to date? You started off really at Google as your first proper job.
Yeah, so even before that, so I graduated from university. I moved to California to go work for Intel, where I was doing technical sales and a rotation leadership program there. So I was always based on the West Coast, but traveled quite a bit for them, and in fact spent a year in Latin America, so working out of our Bogota, Colombia office, doing market development with local PC manufacturers. For example, because of the taxes in a lot of Latin America countries, you don't have the multinationals back then, so there's no easy way of buying a Dell if you're in Bogota. Because the taxes are much lower on parts, it's created a market of local PC manufacturers. So in Colombia, there's several local brands. They manufacture in Colombia, they buy the parts in Miami, ship them in, and assemble the PCs under their local brand name. This is true almost all over a pretty good part of Latin America. And unfortunately, these folks tend to not really be sophisticated like you might see with multinational like Dells or HPs in the US. They tend to have non-technical backgrounds themselves, so I was spending a lot of time with them, helping them build the brand, helping them market their technologies. So I was based in Miami Beach and flew every week to somewhere in Latin America, usually Bogota or Caracas, back when Venezuela was a bit less dire than it is today. While I was at Intel as well, I went to Stanford and studied management science. Intel had a very generous tuition program that footed the fees for all that, so I'm very grateful to Andy Grove for his generosity back in the day. Then I joined Google back in 2004, so back when it was still private and somewhat tiny. I was an early product manager working on the ads. In fact, I was one of the earliest product managers on AdSense, so if you've seen the ads by Google all over the web, I was one of the main product managers for that. And if you ran a website and put those ads on your website, you were logging into the interfaces that I ran. Eventually, I also did pricing and bidding, so working on the algorithms behind the AdWords auction, doing a bunch of things around trying to make the price more fair based on conversion value. And then aside from that, I did a bunch of M&A activity while I was there, so probably the most notable being I led the product side of our acquisition of FeedBurner. So it was a company that let you run ads in your RSS feeds. It was a bit early for the time, and RSS wound up not really taking off quite as much as people thought. But in the process, we acquired a very strong team, including Dick Costello, who eventually went on to become the CEO of Twitter. So it was a very strong team from Chicago that we integrated and brought into the AdSense fold. So I got a taste of deal making with that and a few other things that we worked on at various points. After I invested, I thought about going to Facebook and had an offer there. At the time, California was just beginning the sort of upward trajectory that led to today. So it had fully bounced back from the dot-com bust and was really starting to hit on all cylinders. This is late 2008. Realized I couldn't live with the commute of going from the city down to Facebook every day, so turned that offer down and took an expat assignment with Google. So I moved here to London. Realized that, unfortunately, outside of headquarters, it's a much more of a sales company, so there weren't really a lot of meaningful engineering projects here in London. At which point I joined a VC firm, so went into venture at Fidelity Ventures, which is now called 8 Roads, where I learned the ropes of the business. And then after having met my business partner just about the same time as then, who was at Accel at the same time, we both started Hoxton Ventures, and we did our first closing of Fund 1 5 years and 2 months ago, I believe. So we've been Hoxton ever since.
So you started as Hoxton with Hussain Kanji?
Yep.
What was the idea to go and start your own VC fund? I mean, you've got an amazing career in the corporate world, working with some quite interesting companies, and all of a sudden to flip it and just go and start your own venture fund.
Yeah, I think both of us had a pretty similar impression. So he moved to London for business school, I moved over here with Google. We had a very strong Valley view of things, and at the same time had seen a lot of our friends who were going into venture and had known a lot of venture people. And the DNA of a VC fund in California was very different than what we saw as the DNA of our funds over here. That in California, most funds tend to have a strong number of partners that have either been founders themselves, have been executives at tech companies, or have really seen these billion-dollar companies get created from the inside. And again, most of them have technical backgrounds, or at least a large proportion of the team has a technical background. Whereas here, we found that most folks were very smart, but tended to have accounting or finance backgrounds. And I think for PE, that makes perfect sense, where you can look at a spreadsheet and it doesn't really matter what the company does if you understand the financials. I think in tech, there's a lot more sort of intangible things around, is there a great product market fit? Is the product well built? Is it being developed by a strong engineering team? And unfortunately, we thought that most funds in town didn't really have that DNA. So we both were young and naive that it would be a good idea to start up a new firm. I think on hindsight, the difficulty was far more than we'd ever anticipated, because again, the two things you need for the firm are you need deals and you need money upstream to fund the fund itself. And while there are plenty of deals, and our basis was that European engineers and talent are just as good as California talent, it's a lot harder to raise money. So it took us quite a while to raise the initial fund and collect the capital that we could then make investments with. But it was really simply that idea of traditional California-style VC, taking very high-risk, high-reward bets on companies that have very binary outcomes. They may go to zero, a large proportion, probably a majority, will go to zero. But if you make it work, the top 1, 2, or 3 in the fund, any of them alone can make the entire fund return model work.
You mentioned that the initial beginnings of raising the fund was obviously very hard. How do you go about convincing investors, A, to back you as a first-time fund, and how much was your first fund?
Yeah, so our first fund was just under $30 million, and really, it's like raising a seed round as a founder. It's sort of PowerPoint and a charming smile and a story. For us, it was talking to a lot of folks around the world, people in our network. If you look at how funds are created, the biggest, largest funds often have institutional investors, so pensions, endowments, universities. They're very stable, but they're also very risk averse. So for a first-time fund, they typically won't spend any time with you because A, you're quite small for them. They want to write $10, $20 million checks. And B, it's very high risk that if you're a pension manager, it looks very risky to take a punt on someone who's never had their own track record before or had significant track record before. So it was really family offices that we had gotten to know over the years at our prior firms, high net worths, for example, early Google engineers who did very well that were there far earlier than me and had very significant outcomes from the IPO. Folks like that could write $1 to $5 million checks, and really a collection of them. So we have a lot of empathy with founders that like with a seed round, you're really selling yourself and the idea versus much tangibility or traction. And in VC, there really isn't any traction for 5+ years in general. So we're very in tune with what founders hear, because I think we've heard the same things on our own. And of course, over time it gets easier, and for subsequent funds you tend to upgrade and add institutional investors as you get more successful. So it's been a long process, and we've added plenty of more institutional folks over time. But in the early days, it's quite hard to get that initial fund off the ground. And really, for to do a proper fund, even seed or Series A, you probably need about $10 million of capital per partner to make the fund work. Unfortunately, with smaller funds, just keeping the lights on, paying for travel, unless you're willing to do it, for no salary, or you have your own other means of sustaining yourselves, the model sort of breaks beneath that, where the fees for a small fund don't really support the business itself. So that's always the hurdle. What we tell folks that are raising funds is you really, kind of need one or two big investors who can put together the first 10 or 20 million for you to really kick it off the ground. At that point, it all becomes easier. You start doing deals, and you can do subsequent funds. But you really need that seed capital, either if you're wealthy through your own personal wealth, or through friends and family or business partners or other people who back you with significant amounts of capital.
Having looked into, I guess, the VC model quite a bit as myself, do you think there's still a lot of pressure for VC funds to deploy capital into companies? Because as you say, small-time funds, it is quite hard to make money, especially with the 2 and 20 model. Do you think there is a lot of pressure for VC funds?
I don't think the pressure has changed. I mean, when you say pressure, to an extent, it's sort of market-driven, that are you finding the right companies? I think for venture, the real key skill of the job is 80%. Just can you find and get into the right companies? There's always pressure to deploy. In a fund structure, you tend to have 3 years, give or take, to make your initial investments. Then, of course, you make subsequent investments in existing companies over the rest of the time through your reserves. So you have 3 years when the clock starts to generally make all of your investments. And, for a fund, that might be 10, it might be 30 deals. So there's naturally a cadence you want to build of, finding enough companies to do over that time. And as Europe has gotten a bit bigger and more mature, competition has raised up higher. I think there's still a big difference in competition, Europe versus the U.S., that things are incredibly cutthroat in the U.S., where even if you're Mark Andreessen and you have a fantastic name and a great fund, you still occasionally lose deals to Sequoia or Kleiner. So even the best funds feel competitive pressure, and smaller folks are generally forced to be quite specialized. So that's why you see a lot of funds there that are micro-specialized in consumer cybersecurity deals on the West Coast. Here in Europe, things are a bit less competitive, increasingly more competitive, but still less so than California, where there's so many more funds, and those funds are very well capitalized, so there's more capital that can go into companies.
You mentioned that about the competition before you came on the show. We spoke about the mindset of Americans and, I guess, Europeans. Do you think that whole competitor's got something to do with mindsets?
Yeah, I think the Valley has always been so competitive, and increasingly so, that 10 years ago when we first started doing this, you'd go back to California, and we were fortunate enough to have quite a deep network of other VCs that we had known and worked with over the years. When we go back and talk to them, most of them would say, look, interesting company when we show them one of our deals, but they say, look, too European, we don't want to do a deal that's not a Delaware company based in California or maybe New York. I think that probably was 80% of the case 10 years ago, and now I think that's flipped, where 80% of the time it's a green light, where they're very willing to look at European deals. At the later Series A, Series B stage is where it makes the most sense, just because it's hard to do a board meeting if it's not well planned, and earlier stage companies tend to require a little more synchronous communication. But increasingly, I think the Americans, they don't necessarily have the view we do every day of stuff that happens on the ground here in Europe. So, if you're in London, you can't miss Deliveroo because the drivers are everywhere. Folks in California might not necessarily think of the company then, just because it's not in their face like a DoorDash or an Uber Eats would be. So it's our job as European VCs, I think, to go and remind them and say, hey, this is really good. If you didn't see this before, you should pay attention to it. We found this great company in Berlin or Stockholm. Once they kind of hear about it through us and they open their eyes, then they tend to get quite excited. If we're excited, they tend to share the same excitement anyway. But it's a matter of just out of sight, out of mind, that I think California is a nice place, and it's very easy for folks just to stay in their own little bubble and not really have to think about the rest of the world. It's changing, but it always helps if we can, if we see these folks, and we go back about every month and a half for this reason, show our friends interesting stuff, tell them what we're seeing in the market, and make sure that they're seeing all the stuff that we have to offer, and they're paying attention to the European market, which I think rises all boats, even if it's not one of our deals. deals. I'm happy to see a U.S. fund do a later stage financing of a company in Europe, because I think eventually it all comes full circle and will lead to founders getting wealthy and eventually either starting new companies, becoming VCs themselves, or just overall increasing the market.
And going back to basics, why the name Hoxton? We're not in Hoxton. I'm sure you get asked that all the time.
Sadly, there was a window about 11 years ago when Hoxton was just up and coming, and it was really the ground zero for everything. In the time it took us to fundraise, that window actually closed because there was very little decent office real estate, so the prices got insanely high, and in a quick period of time, probably about a year and a half, Hoxton went from being discounted to about 5 times that price and near Mayfair. So being very cheap, lean VCs ourselves, we decided to not shift out of Hoxton and stay fairly close by, but not necessarily adhere to the neighborhood boundary.
And in your opinion, what makes a great entrepreneur?
I think it's really that killer instinct that, of course, the people around you being able to hire better than you is one of the key things we look for. So, is the founder able to find great people, people that, are probably better than them in any given specialty? I think that's a ultra key skill set. And you see this pretty regularly with founders that, if they don't know what they're hiring for, they hire someone that maybe looks good on paper but doesn't really work out. Someone that's been at a very old school company for 30 years doing product management is probably very different from someone doing product management at Facebook. And some founders, I think, initially go with the safer bet, but we see a lot those folks that learn well quickly get rid of that person and try and find a better person, learn as they go, and upgrade these roles at every time. So we'll see where they might have gone through a few people, but finally bottomed out on a great Facebook product manager that's was very good at Facebook, highly regarded. Then once they see it, they tend to pattern match. So it's a combination of that hiring and just that hunger where they want to take over the world. I think historically in Europe, founders, because they didn't have as much precedent, had a bit lowered expectations. I remember 10 or 15 years ago talking to folks, and a good European company that sold for 20 or 30 million pounds was fantastic. The founder might have made 10 million pounds themselves. They buy a second house in the south of France or a boat, and they're delighted with that outcome. I think probably in the past 6, 7, 8 years, founders look and feel a lot like the ones in the Valley, and a sort of a megalomania where they want to take over the world. They want to be the next Mark Zuckerberg or whoever it might be, which means expansion. It means going into other markets very fast. It means not delaying your international rollout for 3 or 4 years like we used to see before. I think in any industry right now, there's probably going to be competitors in California or somewhere in the U.S. So if you're building a company in Europe, you have to ask yourself, can I compete on the same field as them? Am I just as good? And often that means competing head-to-head with them as early as possible if you are that good. So it usually means going into their markets, again, almost always the U.S., fighting them head-to-head, but effectively being a global company a lot earlier than you may have had to be before when it was more country by country the rollout. So almost all of our founders have a strong U.S. focus for that reason, that they can keep the office wherever they need to keep it, often in Europe, but they'll need to set up a go-to-market team in the U.S. They'll probably need to do a lot of deals in the U.S., or at least if not the U.S., rapidly across the world. Our portfolio companies have offices all over the world. Some of them are focused more on Asia than the U.S., but regardless, they have to jump out of that 1 or 2 country approach, or just UK, France, Germany. They really need to think much bigger.
And you touched upon Asia. What are your thoughts on the Asian markets?
Yeah, so Asia's a bit of an odd one, right? You can group it up into different sectors of Asia and different silos. Sort of China, Japan, Korea, and then Southeast Asia. China is very impenetrable, and very few Western companies have actually succeeded in the internet space going into China. Southeast Asia is very large and populous, but the GDP is fairly low, so they're still a bit early in making money online. There's sort of the basics like e-commerce that have happened, but you haven't seen as many advanced companies because they're quite expensive to do things like SaaS, and there's less of a domestic market for that. And again, Japan and Korea are interesting, but tend to be a bit siloed in their own ways as well. So it's interesting. I think China always has to be watched very closely, that there's so many things happening there, so many ideas that are being tried out, and so many just so much growth to support a lot of different ideas. But overall for tech, not that many of our companies spend that much time on Asia, just because I think the market doesn't really, there's no U.S. equivalent there, or there's a large market you can enter as a foreigner.
And what is Hoxton's purpose, and what are you focusing on investing in? You say you are a slightly different European fund. What makes you different?
Yeah, so we're very much outlier focused. So again, as a rational investor, if someone told you, I have a 50-50, call it a 50% chance of giving you 2x your money or a 50% chance of giving you half your money back, it makes sense to take that deal. And because the downside is limited, people say, great, I'll take that deal. Whereas if someone comes to you and says, I'll give you a 10% chance of giving you 100x your money or a 90% chance of taking a zero, economically and mathematically, it makes more sense to do that. But it feels riskier because there's a good chance it will go to zero. So we're, again, in sort of classic Silicon Valley style, we're very focused on that I'd rather have 10 or 20 deals that all have a high chance of going to zero with a possible upside of a 100x company versus the safer bets that limit the upside overall. So we're very focused on things that we are usually very large markets, multi-country, attacking big industries or disrupting big industries, and with outcomes that we think can be massively large outcomes. So often, we'll say no to deals that we think are very good deals that could be, very easy 2x, just because the opportunity cost of our time is quite high. And if you're spending money even on a good 2x deal, it means you're passing on a deal that could be a 100x deal. So given funds are always constrained by size, you have to say no to some things that could be very nice deals in the pursuit of things that are massively big outliers.
Well, you have two very nice portfolio companies, Deliveroo and Babylon Health. Matt Hancock wants to take digital health records digitally. Do you think Babylon Health can help them do that?
Yeah, I think it's a component of this process. I think Babylon is, a fantastic company. They're doing amazing things right now to alleviate the load on GPs, both here and around the world. It makes a lot of sense that as you're doing more things digitally, the records will also be stored digitally, and Babylon will be a component of that. So I think it makes very good sense that Babylon, if they don't collect the records, will be participating in the records. And for the AI, it only gets better once it has more digitized data. So if you have my entire medical history, the AI component can do a lot better job of understanding my background if it knows I have a history of X, Y, or Z. Versus just seeing someone for the first time without any real context. So as it gets used more and more, it gets a lot more valuable, and the AI can do a better job.
So another two of your interesting companies, Deliveroo and Dogtrace. What's the plan with Dogtrace? Super interesting company right now. What's the I asked companies, what's their BHAG? Where would you like to see Dogtrace in the next 5 years?
I think Dogtrace is a multi-billion-dollar company already by valuation, and is entering the realms of sort of the establishment of very, very large cybersecurity companies. It's one of the few that are started outside the valley, but I think it's increasingly become the dominant player in that space. What Dogtrace does is a bit complex, but it effectively looks at your house. So if all your computers are in the network, if you have a house, you might have guards on the front door, an alarm on the front door, but if someone gets in and is rattling the doorknob to your bedroom, you ought to be quite worried. And in a house, you'd say, uh-oh, that's not very good. Same thing with cybersecurity, that most companies have firewalls set up and there's strong protection around the perimeter, but you may have a computer that your PA uses or your intern's using that's downloading tons of files from your server and sending them up to Russia or something like that. Most systems aren't really designed to catch that sort of intrusion. So if you have someone that's doing that or you have malware, it basically uses AI to look at those patterns of traffic and say, something's really weird. Rob's computer is uploading a gigabyte of files to Russia tonight. Something's unusual. Maybe it's okay, but we should flag it and have a further look. That's become, I think, very, very standard now in the industry, or has become required in the industry. So it's become one of those successful companies. It's now, it sells a very large percentage around the world. They have huge offices in California. They do business with all the big American tech companies. I think it's on a very good path to being a very, very large outcome and a European success story.
And you've got some really interesting portfolio companies there. Do the founders pitch to you directly? Do you reach out to them? I mean, how did you first meet Adi Parcel of Babylon?
So everything comes through network. In this industry, people always say to founders, try and get a warm referral, and that is always, the best way to go. And not even just for the introduction itself, but more for what it shows. It shows that you have a way of reaching people, you have a good network, And I think for anyone, it's not that hard to find someone that knows one of us or another VC. It may not be a fruitful path, but again, it's sort of an obstacle course that shows in a way that you're a person that knows how to get things done and you're able to find the right people. In the case of Babylon, the chief revenue officer was a colleague of mine from Google, so it was a bit easy that I had met him for a drink. He said, this is really interesting, you should have a look. We went to meet Ollie, I think 2 days later, and then the rest was history. This is still when it was at the seed stage. He had just closed the round and then reopened it for us to come in as well, based on this reference. Everything else, again, is almost all come through references. It's come through angels that we know, through other investors at smaller funds that we know, other entrepreneurs. In some cases, we're quite open with folks that if it's not a fit for us, we try to be helpful regardless. Maybe it's introducing them to someone we know in our network. So we have folks, both founders we've backed, even founders we haven't backed, that are generous with introductions as well, saying, look, my company wasn't a fit. We're doing something that's out of your domain, but I met this other founder and I thought they were really good. You should meet them. So it's really that serendipity. This business is a lot of serendipity around finding the right people at the right time and bumping into people. In some cases, finding founders, just recognize other good founders and say, hey, you should have a look at this company. It looks interesting to me.
So you don't mind those hundreds of introductions you get a year?
No, that's the job. I mean, this job is pure. It's meeting people. It's getting to know folks. It's CRM, human CRM. That I think it's a matter of knowing the right people, talking to them regularly, making sure they think of you when they see something interesting, and then being able to jump when you see a good deal. I think this business, if you're not doing hundreds of meetings and hundreds of introductions, then you're probably not doing the right thing. And again, I think one thing that we learned a lot in the Valley, and might be a little bit less prevalent here in Europe, is just that pay it forward culture where we try and be pretty generous in this way. So if someone is doing self-driving cars and has a really good opportunity to work with Uber or Waymo or something like that, we can easily call in a favor with a friend who's an engineer there and introduce them to Uber's self-driving car guys or whoever it might be, Facebook's ads team, things like that. We try and be pretty generous, and again, it comes back to repay itself in strange ways where there might not be any immediate value to us, but then hopefully that person will remember us later when they're doing their next company that's something we're interested in, or they know someone else that then they intro to us and say, hey, these guys were helpful, you should talk to Hoxton.
And for our founders and listeners who are looking to raise, who maybe don't quite understand the investment process, could you maybe just go back to basics and talk to us, how does an entrepreneur get to pitch to someone like you guys?
Yeah, so for us, again, almost everything comes through people. So, find someone that's worked with us or knows us. And of course, the warmer the referral, the better. If it's someone that knows you well or can really vouch for you. I think Hunter Walk, who's another VC, often talks about this as, warm intros versus cold intros, in the sense of, will I really vouch for you, or am I just saying this person asked to intro, can I intro? The warmer the introduction with the bigger vouch, the better. So if someone can say, I work with Rob, he was really good, he was in the top 5%, you should take a meeting, that sort of sets the priority for us. At that point, we're pretty fast and lean ourselves. So usually that introduction will come with a deck. We look over the deck. If it looks interesting, we'll take the meeting. There's probably a couple more meetings. Usually my partner we'd loop each other in at various points in that process. Then build conviction. Usually find ways of doing references or market checks with people we know and people we know in the industry, depending on what the industry is. And then we can generally move pretty fast off that. So most of our deals tend to be quite fast in process. There's not a lot of overhead. There's not a big partnership. Some firms have a very large partnership process where you go meet everyone in a big mahogany-tabled boardroom on a Monday. We're a bit more informal than that we like to, of course, spend time with the founders. But usually it's over coffee and Shoreditch versus in a big, giant boardroom.
What's the worst business idea you've ever heard?
Oh, man.
There must be one, eh?
We get a lot of fun cold emails that have all sorts of bizarre ideas. A surprising amount of cold fusion. So I don't know if I can limit it to just one, but lots of cold fusion / perpetual motion investors. I don't know where they come from, but they tend to be self-taught researchers that are doing experiments in their basement that are convinced they've invented cold fusion. I think those are probably just among the worst. That our standard reply is, this firm obeys the laws of physics and science here, so it's not a fit for us, I'm afraid.
And is there one company that you met which you wish you invested in?
Oh, lots. I mean, I think like any firm, you have to keep an anti-portfolio of deals that you missed or didn't do that turned out to be great deals. I mean, there are plenty of things like Monzo, for example. My partner at Cohen had invested as an angel in the prior company, the founder, Go Cardless. We were easily, in a good relationship with him and could have, jumped into that deal. And we thought it was a bit too UK centric at the time. UiPath was phenomenally successful from Eastern Europe. Same thing. We'd met the founder and weren't convinced the growth was quite there yet. I mean, there's a long list of any fund of things you miss, and to me, those are what should keep a VC up at night. Those are what keep me up at night, saying, how do I avoid this in the future? How do I make sure I don't miss this kind of deal ever again? What tools can I build? In the subsequent years, I've done a lot of tooling myself and trying to identify patterns of looking at company growth, hiring rates, company finances to try and identify this better. I think a lot of firms are moving in this direction now of using data science to screen companies better. So for me, the headcount numbers are very important. So I keep a very close watch on hundreds of companies this way to see particularly, the time between their last fundraising and looking at the growth. That's a pretty good proxy that if it's, 6+ months after their last financing and the company is still growing, something is working pretty well. It might not be clear what it is, but usually it's a good sign that companies that are going bad, if it's 6 months after the fundraising, usually that means they're tightening their belt and they're trying to avoid running out of money, so they're cutting costs. So if the company is doing the opposite, you can usually infer that's a pretty good sign. But that's the real, the unsolvable problem of VC is that you just don't scale yourself, so you can't always talk to every company. How can you find these ones, and particularly the ones that might not be growing or might not be convincing yet, but change in 3 months, 6 months, 12 months? How do you re-intercept them and make sure they don't get away? I think for every VC, that's a pretty common problem and something we all struggle with doing properly.
And for those companies that sadly don't work out and they have to close, is that a really difficult conversation between the entrepreneur and the investor?
I mean, I think the relationship ought to be good enough where it's probably not a surprise. And I think most founders, frankly, can understand that, their time costs ought to be valued highly themselves. And if a company is not working, it's probably better for everyone to find it a home inside a bigger company or find a sale versus letting it flounder. I think we've had lots of companies that have failed. And I think for all of them, I regret not starting a process to sell them sooner. I mean, most of these companies are sellable in some way or another. Maybe it's a very small acqui-hire, maybe it's something better. But when you see a company hitting the wall or just not scaling like you expect, I think it's good for everyone to explore a sale pretty early. And as part of the process, hopefully the company knows the buyers of the company or the potential buyers who might take it over, and hopefully they're in conversation, so it's never out of the blue. But a lot of our job, again, is trying to help that along. So if we decide a company is not going in the right direction, it's convincing the founder that it's probably a good time to sell and then helping them, run a process. You can't really use bankers for this because it tends to be quite small generally. But if you have, 4, 5, 10 people, these are acqui-hires that lots of companies will do. So if the founder's on board with it, before the company runs out of money and gets desperate, you should be talking to all these potential acqui-hire buyers and try and figure out the best home for everyone. It's good for the employees. It's probably better for the founders, an opportunity cost, and saves a little bit of cash on the investor side, or lets the investors recoup some of their capital.
And on the other side of the table, what do you think the big trends are for 2019 and for the next 5 years? In particular, we're seeing a lot of fintech companies coming out. We had Tom Blomfield, founder Monzo, on the show last year. Do you think fintech's overhyped? Do you think that there is still a massive market to be disrupted?
I think it's still underhyped relatively. I mean, we're only scratching the surface right now of sort of consumer fintech, and I think it's still early days. London's been quite fortunate to be a hub for this, and I think you're seeing most of the global innovation happening here. But I think lots of regulated industries are being overtaken now or being challenged for the first time. If you look at tech, it's always a curve of attacking different industries or approaching different industries. And I think regulated industries are among the last because they're quite difficult and require a lot more capital often or a lot more industry expertise. But I think even in the past couple of years, looking at Revolut and Monzo and TransferWise, you're seeing a lot of things that were heavily regulated now being disrupted by these startups. I think in the same way, insurance is still very ripe for better engines for pricing, better distribution. A lot of regulated industries that were formerly hard to attack, I think, are now showing signs of cracking or showing signs of yielding to competitors. And these are industries that simply don't have the talent in-house to really do that much innovation. Unfortunately, most banks, don't have innovative tech people. They have great operations people often, but they don't have people that are building best-in-class mobile apps. If you look at open banking, for example, most banks have done a dreadful job of implementing that, where the APIs don't quite work, or they don't quite work reliably, they're second-class citizens in the company. It's disappointing, and I think you'll see a lot of innovation there as people say, look, let's just start from scratch with a clean sheet of paper and try and reinvent all these systems a lot more cheaply and efficiently.
So on that note, do you think the UK is still the right place to start a business?
Yeah, I think, of course, nothing beats California for sure, and you can't really argue with the success of Silicon Valley. I think it's quite a unique place in time, particularly for London, that there's an attraction because all the capital is here. So by probably a 2 or 3x margin, there's more capital here than there is in any other city in Europe. There's again a greater density of tech talent. It's very globally friendly because it's English. It's quite hard in other cities to live without speaking the local language. It's doable, but a bit more difficult. And again, it's a global hub for talent that people around the world still want to be in London. I think in the U.S., the politics have created a unique scenario where people are thinking about leaving the U.S. Across the board because they don't like the politics. There's people that are fed up with the traffic and congestion in Northern California right now. So it's a great time where people are leaving the Valley probably more than they're going to the Valley. And London, for sure, in Europe is the biggest beneficiary of that, where if you're doing any sort of tech, London makes the most sense. You have the capital, you have the people, and you have the support and networks that get better and better over time.
And for Hoxton itself, what's your BHAG, the big, hairy, audacious goal? Do you have plans to potentially launch another fund at some point?
Yeah, of course. I think with any fund, the first job is find unicorns, find large scaling companies that will become global winners. That's the underlying goal across the board, and I hope we're doing that for 20 years more. Again, I think there's room in the market to build more platform-style VC and support different stages of the market, as well as offer more services. I think people like Andreessen Horowitz have done a very good job with having a lot more focus on staff, providing portfolio resources. That's still a fairly early concept here. There's a few firms that are trying it in different ways. But it's hard to do and it's quite expensive, so it's a big investment for most firms. I think there's a big opportunity there. So over time, I hope as we get bigger and raise more subsequent funds, we'll have more capital to do that. And hopefully, it'll give the companies an outsized ability to scale or help give them that extra boost that they otherwise might not have in the market.
And in the last 6 years, what's the one piece of advice you've learned and you would give to an entrepreneur?
Honestly, I think it's think about the U.S. market early and fast. I think if you talk to founders that we've backed or people that we know for nearly every business, if there's some point in time where it makes sense to be in the U.S., you probably ought to go sooner than later. I think setting up an office there, even if it's a very small office just for a few customers, I think the sooner you target that market, the better. And again, it's not to be anti-European. I think there's plenty of great markets here to attack. But if you're resource constrained, again, for any company, there's probably some competitor doing the same thing somewhere in the U.S. And unfortunately, they have the benefit of having a lot more capital available. They have the ability to find people probably a bit easier, just because the talent is a bit deeper there. The talent pool is a bit deeper. So if you're going to be in the U.S. at some point, better to start early and start building that footprint and building your buffer there, versus leaving it for someone else to build a much bigger moat around you. So again, I look back to our companies and talking to founders all the time. I don't think we've ever had anyone regret not going to the U.S. earlier. Everyone has said, yeah, I think that was a good idea. I should have gone a bit earlier and attacked that market earlier. So not to say you do anything different in Europe. So keep your office here, keep hiring people here, the salaries, and so the value is significantly better in Europe often for hiring compared to California. You can get people for half the cost. But for sales and markets, most of the biggest customers tend to be there, and you're a bit silly if you don't go after those customers earlier than later.
Awesome. Well, thank you so much for your time. Just before we finish, if our audience have got any interesting companies, how can they find out more about you?
Email me. We always take emails, and we do look at cold emails. We don't always have the ability to respond to all of them, but if we have mutual friends or if we have mutual connections on LinkedIn, see if you can nudge them to send a note. But I'm always available, rob@hoxton.vc. Send away.
Awesome. Rob, thanks so much for your time and good luck with it.
Cool. Thank you.
Thank you.